Introducing pro rata payments on the Green Star Trading Patreon service. That's right, Patreon have finally gotten around to rolling out a pro rata based payment system. So instead of the problem of potentially getting charged when you sign up late in the month and then again on the first of the following month, you will now only be charged on the day you signed up each month going forward. So, I no longer have to recommend that you only consider signing up at the start of the month. You can sign up anytime you want now, and you'll be getting charged the way you should always have been getting charged, in my opinion. So feel free to follow the link in the description box below of this video, come over, have a read of these tiers, and then feel free to sign up whenever you like. Let's have a quick look at what we've done lately. So we've now got 165 exclusive posts. The vast majority of them are videos and educational content and live streams. We've got a recent live stream here from the 10th of November. We've got a new video for the Elliott Wave series, which I think is now 15 odd videos long. This one was on wave personality. I've got one to follow on corrective wave personality that should be coming along soon. We've got another live stream here. We've got the top dividend stock picks for the month of November 2022. We've got December coming along in just over a month as well. There's so many other benefits. I'm not going to read them all out to you. Feel free to come over and have a read about those benefits and sign up whenever you like. We would be very glad to have you. Now, let's get back to the video. Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right then, it's time to look at the US stock market using our proxy for the S&P 500, the SPY. We're going to look at the PCC and the VIX as well, as we always do. And I'll have to apologise in advance if I'm coughing and spluttering during this. I've unfortunately picked up another cough. Feeling perfectly fine with it myself, just can't seem to shake this one over the last couple of weeks. But either way, let's press on as best as we can. We're going to start on the monthly time frame for a moment, just with some really simple classical analysis before we come into the Elliott wave counts, just to try and get a feel for what's going on the longer term here on the SPY, what we've come to, why we've had this significant bounce, nice strong rally that we've seen. We are still in a downward trend of lower lows and lower highs. We're still below a major resistance trend line. Excuse me. And although there are voices out there getting bullish, they might be right to do so. We won't know until we look back in hindsight whether they were. But we've got a lot of work to do before we can come out of here and be bullish with any real confidence. So, over the long term, we can see that on the monthly time frame we've come back to the 60 exponential moving average, which is the orange line here. We came down to the absolute tick, kissed it, and then bounced back up. Now, this serves essentially very similar to the 250 exponential moving average on the daily time frame. It's roughly the same. It roughly always falls in the same area, and it is essentially the line which divides the bull market from becoming a big bear market. In other words, the moment at which we cross below this, backtest it, and then continue to fall is a sign that we are in a much more significant correction over a more significant period of time. So we're in this little state of limbo, having come back to it here. We can see how we wicked below it during the 2020 panic of COVID, but we've stayed well above it throughout the bull market since we recovered, tested it, came below it, back above it, tested it and moved on. And this was recovering from the previous bear market of the GFC. And then since then we trend higher, just as once we trended higher into the GFC and we trended higher into the tech bubble, and then when we broke this thing we continued down, we broke it and continued down. So we're at that point now where we tested it, and as you can see, having come down prior in these larger crashes, we bounce and then we break it, back test it and fall. We come down to it, we bounce, break it, back test it and fall. So are we going to get the same thing again? Are we going to come down, bounce, break it, back test it and then fall? You know, and have a really significant bear market, a really significant sell-off? Or are we done and we're going to have a hell of a rally? Now, we could be off into a new all-time highs, and we could be off into a wave 3 at a larger degree by my more bullish count. So, or we could be into an expansive correction which does something like this, and we're not going to know it was a huge flat until we make a higher high and the lower low. So like I said, early days. If we come down to the weekly time frame, you'll see what I mean when I talk about the 250 exponential moving average coming down to the tick, essentially serving the same purpose. We come down into this demand zone here where we've got this prior buying activity. We can see around the point of control in our fixed range volume profile from the March 2020 low. We just come into that area at the 60 monthly exponential average and the 250 weekly exponential moving average. Touch it and then bounce. Another interesting point would be the Fibonacci retracement we have from the March 2020 low, which was also providing to the tick support, which was the 50% retracement of everything gained from the March 2020 low. We've given back 50% of that rally, came back to the 50 level, came back to the 250, came back into that prior demand, and we've bounced. So for the moment we're rallying, but we're still below trend. Okay, you can see these previous highs. We might be coming back up again to test it again before we make that move lower. Okay, so we're still in a downward trend. We can see if we bring up a regression channel to surround this data here, we can see that we've come back to the upper bound. We've broken it before. We may break it again to test that resistance. We're coming back up to the 60 weekly exponential average here, which is the orange line, which will likely act as resistance. We also have some strong resistance levels that we have previously tested and may test again if we come higher. For example, we had these two tops here for the week starting the 24th of October and the week 31st of Halloween, where we were trapped below this resistance level here, which was prior resistance, prior support, prior resistance, prior support, becoming resistance. But we have moved above that level since, so perhaps we need to back test this before we can move any higher, or we'll move below it and then it'll be resistance again before continuing the route. So we really are at a bit of an inflection point at the minute. We've rallied a significant amount. We came to significant levels from which we rallied from, and if we look at what we've done in the retracement, it's another very technical level, which is the golden zone retracement, 61.8% closing, well not closing, but intraday price came literally to the tick with the wick here to the 61.8% retracement. So we've come down in a move, we've come back to the golden zone, and that's after coming down to a 50 on the larger time frame and bouncing up. So we really are in one of those limbo situations at the moment where we need to see several things to happen before we can be confident either way. Okay, so now let's bring up our indicators and see what we're looking at here now. One of the things I've noticed about the RSI on the weekly, this is a weekly divergence we've got on the MACD between the low and the higher low, and we had this acceleration, essentially this increase in bearish momentum, and then we've had it taper slightly, significant bounce back in bullish momentum, but then that has declined also. So we're getting this narrowing pattern in the histogram forming. This generally is more is more of a consolidation pattern than it is necessarily the signs of a new rally. However, we can continue to head higher while this histogram declines if we do pick up bullish momentum. We saw that off of the March 2020 low. Here is the real first move up, which came all the way back in August 2020, and then it was a creep to new highs as that momentum started to cool off. So you can still continue to push the market up significantly over that time period. So just because we've seen this whipsaw back doesn't mean that we're necessarily shooting off to a rally, but it doesn't mean that we can't rally. You know, so we do have that divergence on the weekly time frame though between the closes, and then if we look at the RSI, we get a similar picture here as well, where we've got between the closes here we have a series two-way divergence now, bullish divergence between lower lows in price and higher highs in RSI. So a rally's been on the cards ever since this first low came in here, and this subsequent low on the 26th of September was screaming for a rally to occur, and that's, you know, we spoke about that in the previous weeks. We've mentioned this RSI, so this divergence several times, and the level we've come back to, the 50, the 250. Go back a few weeks and I was talking about how we come back to my long-term old targets that I set up all the way back from, I can't remember when it was now, but where are they? I was always targeting the 50 and the 61.8 as a potential retracement. So having come down to there, to a major moving average, found this bullish divergence, not surprising that we're bouncing. So now what do we need to do to get out of here? Well, before we come in and look at the counts, we want to see this sequence of low, lower high, lower low, lower high, lower low, and lower high. We want to see that break. From a bullish perspective, at least, we want to see this sequence break down. Now that does not necessarily mean we're off in an almighty free, but we could be off to new highs as part of a corrective structure before coming down again. It's all about scale. It's very difficult to get your head around the kind of scales we're talking about, especially after such a significant rally. But we only really need to come back to the huge flat pattern here of the tech bubble bursting and then the GFC, and we can see that we've had a higher high and a lower low off of a 3-wave swing. So this move here could not have been a 1 and a 2 off of this pivot, because we came back below where we started. So this whole thing is a correction, and it was 9 years long. Okay, it took 9 years to do that. So this is what I mean by perspective. You know, we are always in such a rush and such a hurry to get things done, but if you were to look at a several-year, multi-year correction again, okay, you've got so much potential room to come down, come up, come down, and end up with another huge, larger wave degree correction. Okay, so that doesn't necessarily mean we're off, you know, and running in a wave 3, going up and up and up and up, but we could be. But it's kind of all a moot point really, guys, because until we get through this downward trend and break this habit of lower lows and lower highs and get out of that regression channel we looked at as well, break this downward sequence, see volume come into the market, see bullish momentum continue to pick up, overbought conditions on the RSI on the weekly time frame would be nice, at least sustained period on the daily time frame to get some real power, some strength behind the rally, and then you can become confident. But you have to remember, any move up, whether this is going to be a zigzag higher, it's going to be a 535 structure, or whether it's going to be an impulse of 53535, you're going to have a move up and you're going to have a move back into all of this, because that's going to be 1 into 2 or A into B. Okay, so then we're going to move higher again. So if you're breaking this downward trend, that would be how I'd be thinking about it. I'd be thinking 1, 2 or A, B, we will break this and this will be part of a 3-wave move higher. At least it could be 4, 5, 1, 2, 3 over the next few months and into 2024, 25 and beyond. Okay, now a much simpler situation obviously is that this is not over and this downward trend is going to remain, and this is simply another connection between a 5-wave move into an A, B and a C, and we come down again and we fall down below at 250, and then we'll go through the process of consolidating to backtest it like we have done in previous bear markets, and then we will continue the route even lower. Okay, and you'll have a real breakdown in price. All of these things are possible. So getting out of this downward trend, getting back above the 60 weekly exponential moving average, breaking this downward resistance trend line and seeing some strength behind that move, I would be looking for, at least after doing that, a 3-wave pivot higher. That's what I'd be expecting to see once we do that, and that's what I'm going to be looking for in the coming weeks. But let's not misguide you. The primary count is still bearish. When we're in a downward trend or an upward trend, the trend is your friend, and for as long as it stays and continues to display strength and directionality within that trend, you should primarily focus on a count which supports it. and that's where your primary should be. And my primary, until these things change, is still going to be bearish. I talk about the bullish case because we're at a potential inflection point, a 50% retracement, a major moving average, a potential break of a downward trend. I want people to be aware of that and thinking about it, but that doesn't mean I flip bullish. Okay, you've got to be ahead of the game, or at least trying to get ahead of the game. So on that note, let's now come down to the daily time frame, and let's have a look at the various counts we've got here to explain what we're seeing. So let's just get our way into the top, and let's look at the primary first. Okay, so this is my primary. I've seen several attempts to count 1 flat into 2, 3, 4 and 5 into A. That's what you want to do, and you want to count it that way, and you want to count it as an impulse, and you can make it work. That's acceptable to me. My issue with it is I've never been able to get this first move off of the high to divide as 5. I've only ever been able to get it to work as a 3-wave swing, so I prefer to look at it as a zigzag. So to anyone who's thinking that, if you want to interpret it that way, it's really not going to be all that different, but I see this as 3, not 5. So I see that as a zigzag. I see this as a flat, and then I see this as another zigzag. Okay, now this is arguably, you could argue 1, 2, 3, 4 and 5. Okay, I think it looks better as a 3-wave pivot with a slightly shorter C. The C comes beyond the A, so it's exactly what you'd expect it to do in a zigzag, but the relationship between the two is not great, admittedly, but it doesn't have to be. We then get the opposite. We get a weak C here, and we get a powerful C here where it goes to extension, 3 waves again into an X. Okay, couldn't have been 5 unless we're seeing this whole thing as a flat, right? That's also another possibility if you want to, but then you'd have to somehow subdivide this as a zigzag when it looks like 5 to me. So in other words, there's going to be differing opinions about exactly what this is and exactly how to subdivide it. It's not the lovely clean bearish impulse from the high that would have made life extremely simple. If we'd just gone 1, 2, 3, 4, 5 off of the high, then we'd know beyond the shadow of a doubt, especially if we see divergence between these two lows here, that we'd be looking at 1, 2, 3, 4, 5 into A, and then we know that we're going to get a B, commonly a shallower retracement in the bear market, then it's wave 1 or 2 counter in the bull market, and then we would continue down in a C. We were not presented this, it's just the way it goes sometimes, so we've had to be a little bit more flexible in explaining it. But either way, we come down in another 5 waves into a minor A within what I think will be the final Z wave, or another double zigzag potentially. We'll discuss that as another alternate in a moment, going lower. So we've either gone A, B and a little bit more to go in the C, because I don't think this is quite 5 waves yet, but it's very close to potentially being 5 waves. That's 1, that's 2, this could be 3 into 4, and that could be 5, and that could be C. And we've got that trend resistance above us that we discussed. Okay, we've got that 68 exponential weekly moving average, we've got a regression channel. Alright, we could just poke on those back into resistance, and that could be A, B, C done, and then down we go. It could even be done already. Okay, and maybe this is 2 zigzags, W, X and Y, rather than A, B, C, in which case the retracement here to the 61.8% could have been all she wrote, and now we're going to turn down 1, 2, 3, 4, 5. So this week is going, this next week or two is really going to help clear things up, I think, for the longer term. Right then, so that's essentially the primary. Expecting to find resistance soon, expecting to see weakness near those highs, near a local high, and then to roll over and head down in another 5 waves. So let's talk about the bullish interpretation off of the low. This idea is that it was W, X, Y, X, Z, but it's done. It's already completed here at the 50% retracement, at the 250 on the weekly, at the 60 on the monthly, and we've come up here in 1 2 1 2 3 4 3 4 5 1 2 1 2 3 4 5 1 2, and then we'll go up higher and higher, and we'll break this downward trend, and we'll get a big powerful wave 3 erupt soon, and we'll get a clear sign that we're coming out of the low here. Invalidation for this is 348.11. Any move lower invalidates the current bullish interpretation. Let's come down to the 8 hours so we can get a little bit clearer subdivision here. Let's come down to the 4 hour actually, so you can see how I've done this. All of this, that's kind of irrelevant. It's basically the same as the bearish count. So coming off of the low, and you can look at this in a couple of different ways. You can look at this, I think if we look at it in line, it's going to be easy to explain. So the idea here is that we had a truncation in the wave, in the 5th wave at subminuet degree of the wave 1, and we went 1 2 subminuet, 1 2 micro, 3 4 micro, 5 3 subminuet, 4 5 minuet 1 into minuet 2, and then we've got 1 2 3 4. With the daily information of the ETF here on the SPY, it's a mess, and it often is a bit of a mess, but we get all of our volume data and other flexible tools that we can use here with the ETF data that we don't get on the SPX and we don't get on the futures, you know. And you could argue that the futures are not the correct thing to be analysing, because it's not the greatest market of participation during market hours when cash flow is king. So that's something that different people agree on or disagree on. I'd much rather use a cash only market if I can, that's trading during, you know, actual trading days, trading hours on trading days. That's why I tend to lean into using the SPY ETF instead. Either way, if you were looking at the futures market, there is an alternative idea, which is that this was 3 waves into a 1, 2, 3 waves into a 3, you get an overlap outside of market hours for a 4, and then 3 waves into a 5, 4, a diagonal, which we'd have to go over and have a look on the ES1. But that's probably the way I would look at it if I was looking at the futures. So, if I had to pick, I'd say this is a pretty shoddy looking impulse. It doesn't subdivide very nicely, and I would probably say the primary count still makes more sense, as this, I think this looks better as a series of zigzags moving higher correctively. Could be wrong, but for the meantime, while still in that downtrend, we're going to stay with the idea that the primary count is still correct until proven otherwise. So, right then, that is essentially the Elliott wave picture. There is one other Elliott wave count, 2 other Elliott wave counts, sorry, but these are both alternates to the primary and the primary alternate, if you know what I mean. The major bear, as I've called it, this is the idea that we're in an expanding, leading diagonal. Okay, and that this will be zigzag, 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 rather than impulse waves. Still prefer it to divide as zigzags. This is another zigzag here for the A, the B, and then we're going to get a thrust down towards this lower trend line in the C. Now, if this is a expanding diag, we will likely fall short of this lower trend line, as that tends to be the habit of expanding diagonals, whereas contracting diagonals tend to have a throw over. Expanding diagonals don't always display that behavior. In fact, they more commonly don't display that behavior. So this would be a scenario that is very, very bearish on the long term, because this is a motive structure of this is a motive structure of 5 waves, which means it's going to be labeled A, and it's going to be part of the zigzag. We can never start a flat correction with a 5, so it has to be 5 into an A of a zigzag, which means we're going to get that move down below that 250, that 60 on the monthly, into that A. We're going to get that back test in a B of those levels like we saw in 2008 and we saw in the tech bubble, and then we're going to have a further collapse down in a C, which would more likely alternate into an impulse as opposed to a diagonal, but it could still be a diagonal. but I would bet on it more likely see waves in the large bear markets are devastating normally, and therefore I would probably expect an impulse going down. So this is a very bearish count, and if we do see another 5-wave move lower, we have to probably bump this up as maybe, I'm not going to say superior solution to the primary count yet, but probably a more elegant one in terms of the longer term structure, the longer term picture. It will probably make more sense, but that will require a bit of a rethink on the longer term as well. Then there's another alternate, which is just a mild a slight change of how we've counted the W X, Y, X, Z, which instead of saying this is a primary pivot or an intermediate pivot, is saying W, X, Y, X, Z. What we can suggest is that this is one move of a double zigzag, okay, into an intermediate wave, a zigzag into an X, and then a larger zigzag into a Y. I think this is probably a more elegant solution, as it requires less larger wave degree pivots than the primary count does. But for the moment, I'm going to keep the other one as primary, because the subdivision in some of these swings isn't as neat, or maybe I'm being too picky. I prefer the subdivision in the primary count over this interpretation, but I think as a larger correction, because of how smaller these zigzags are relative to what we're expecting here, this kind of makes sense as one move, and then this is one move, as opposed to 1, 2, 3, 4, 5 moves in a triple zigzag, if you see what I'm saying. So, and it's just a mild, just a slight alternative I'm working on in the meantime. So there you go. Let's come back to the primary. Let's come back to what we want to see, and let's come off of log so it makes sense. Let's bring back up that fib retracement. So the swing high of our current X wave here. This, if we cannot have a zigzag lower leading with 5 if we come back beyond where we began, because a B wave cannot do that. So if you're a bull, breaking the trends are positive, right? But breaking this pivot is really what you want to see. Okay, because then you've broken the downward trend, you've broken this count, and you've broken the alternative count as well at that point, because this is still an X wave pivot, and we cannot have A, B, C coming down as a zigzag in a double zigzag, because the B can't come back beyond where the A began. Okay, so breaking that pivot is absolutely essential for the bulls if they want to make further progress after getting out of a downward trend. Just because the trend breaks, the trend line breaks, doesn't mean the trend's broken. That's the high. Coming above it and back down, that would still be a lower high. We would still be in a trend of lower lows and lower highs. So let's just put a little line here then, and what should we call this? We'll just put a default there, and we'll label it 43124. So we want to come back above here. If you're bullish, that would be, actually I've got to move it a little higher, excuse me, 13173 to be accurate. So what we call this, major pivot, we'll call this, lock it in place. Okay, so break the downward trend, get above that 60 exponential moving average on the weekly time frame, get above this pivot, and our current interpretations, including the diagonal, the really bearish count, all of them break at that point, which means we'd have to come back to the drawing board for a bearish count, at which point I would probably be, as an alternate for the bearish count, I would be leaning into the idea of an expanding larger structure, and I would probably bump the bullish count into primary, at least in the meantime, with the new bearish count in alternate. But we've got a lot to see yet before we get there, haven't we? So let's not jump the gun. We're at a pivot point. We're at a 61.8% retracement of this move down. If we get rejection here and an impulsive move down in 5, that's potentially 1 into 2. You should be looking for a retracement to short it. Okay, so now let's come over and have a look at the PCC. This thing, to me, I go back and forth on this frequently. This makes me feel like the market's bottomed. It really does. I'm not saying it has, I'm just saying it just makes me feel like it has. This downward resistance line we've had here over the years, back in 2011, 2015, 2019, 2020, then here, then here. We've got this downward trend line. We've come back into extreme fear and panic. Well, not quite above extreme fear and panic, but into significant fear and panic after setting new lows in what we call the extreme greed and complacency zone. And then we've come up above the 60, has come up above the 250 exponential moving average, trended impulsively above it, back to it, then set a lower high. Okay, now is it consolidatory and we're going to move up again, or was that the peak? I've marked the PCC extremes on the SPY chart, which I've showed you before, and that divergence plays out into the rally that we've currently got going on in the markets. So we've got lower lows here. So do we now come down, break this upward trend of the 250, the 60 over the 250, and start to see one of these trends form instead, where we stay below the 250, maybe we come back through it, down, and we do something like this, or a sharp sudden thrust down? Either way, a sign of the 60 breaking through the 250 is a sign that that bearish trend, that trending towards fear and panic, may have come to an end, and now we're going to start working our way back down over the next year or two, back into, or longer, back into greed and complacency again. So a lot of fundamental factors obviously at play at the moment. We've had a decline in the CPI, not a decline, it's accelerating at a lower rate. I still expect the CPI in the US at least to continue to tick down in the next few months. I think there might be some sticking points for a couple of months hanging around, or slightly increasing, slightly decreasing, but I think once the trend down begins, I think it will actually accelerate, and I think interest rates have gone up far too fast and far too violently. And when I look at the leading indicators, which we'll be looking at as a group on the Discord and with my patrons later, maybe not this week but maybe next week, we've got a lot of data coming in the last week of November, probably a couple of dozen leading indicators to look into. And a lot of them are still pointing very bearishly towards a severe contraction. So if you're annihilating demand, it's only a matter of time until it shows up in the lagging indicators, which is the CPI and employment data. So maybe we've peaked in terms of fear and panic. Now the VIX, this one continues to just disappoint in terms of what one would have hoped to have seen with a major market low. We've never, even with the recent lows, we are still compressed below the previous highs we were in the VIX, and we still have a rising trend in the meantime. We're going into some kind of like triangular compression pattern, you could argue, in which case you could argue for it to break out, or you could just argue for it to break out to the downside as well. Maybe even break this long-term support we've had since 2017. Now obviously that was a knee-jerk response to me drawing that line, but you get my point. We could be looking to come back down to this long-term support. We could stay inside of this rising thing and contract again and continue to compress, or we could finally break out higher and have a panic moment. That panic moment just hasn't occurred. You know, even an elevated VIX reading just hasn't occurred. You know, that's the most recent elevated reading we had, and that was back in January of this year. And we actually didn't set the market lows until June, which was off these tiny little highs here, which aren't even in the previous zone where we would expect to see the VIX peak. So, you know, it is what it is really. At the end of the day, it's just not seeming to really give us any signals at the moment. Maybe if this compression pattern breaks out violently one way or the other, that would be a sign of confidence that the market has indeed bottomed, or a sign that we are going to go a lot deeper. So there we go. I feel like I've been waffling a fair bit today. Sorry if I bored you a little bit, but I think that's all I've really got for you. So summing up on the SPY one more time before we go, we're still primary bearish count. We've come back to a golden zone retracement after a 5-wave move lower. We have every reason to consider the possibility of now continuing that downward trend. If we see the opposite occur, a break of this downward trend and then a break of this major pivot, we have to, I think, only fairly consider a more bullish count, at least in the shorter term, as in the next few weeks and months, and change our primary and alternate, you know, for the longer term as well. So that's it, guys. That's all I've really got for you this week. If you're new to the channel and you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. And as always, a huge thank you to my Patreon subscribers. Your support is massively appreciated. If you're interested in joining the Patreon, some good news on that front. It is finally on a pro rata basis, as Patreon have finally introduced pro rata payments, so you don't have to worry about signing up at the start of a new month anymore. You can sign up whenever you like, and you'll be charged, thank God, on that day each month thereafter. And for all members who have currently joined up on the old payment system, you will still continue to be charged on the first of the month, but just that day on the first of each month going forward. So there you go, guys. There's a link in the description below, so if you are interested, head over, have a read of it, and feel free to sign up whenever you like. And if you're not following me on Twitter yet, there's a link to my Twitter feed as well, where I just post the videos I post on YouTube in case you miss your notifications. Take care of yourselves, guys, and I'll be back with you as soon as I can. Bye bye.